What's up guys, it's Matt. So in this video, I just wanted to give a quick technical tip for some of you that might be entering your trades based on FOMO. This typically ties into having bad trade entries, which of course you don't want. And I'll also mention how this ties into patience. Before I get started, I just wanted to let you know if you find this video helpful, make sure to drop a like on this video and subscribe to this channel if you have not yet subscribed. And then you have links in the description to join my trading community if you're interested, or where you can become a Patreon supporter to gain additional perks as well. So when it comes to the fear of missing out, as I've discussed in a previous video, which if you haven't watched, be sure to check it out. But basically, I discussed in that video how FOMO occurs because we don't want to miss out on any moves, which could potentially be the ones that grant us some rewards. However, when it comes to the markets, typically, whenever you have this fear that you're about to miss out and you enter a trade, majority of the time, so I'm not saying this always happens, but the majority of the time, this will tie into having a bad entry or having a risk to reward ratio that's not that great. And so one example that we can take a look at is on the dollar yen. So this is something that occurred just a couple of weeks ago, but let's rewind this back to what the market looked like before and notice how during this time of year, the price action was consolidating and it was simply moving sideways, so there wasn't too much action. And this is where I can guarantee that, of course, this is the daily chart, so maybe on a smaller time frame there would have been some action, but any beginner trader especially that would have looked at this chart, they would have seen that the price action is moving sideways. There's not a lot of action, so they wouldn't be attracted into trading this. And this is typically one of the common mistakes that many beginners make, and that's where they're constantly looking for action. Because of course, if you're a beginner, you're not thinking about the months and months that you have to put in to learning how to trade, whether it's through back testing or practicing on a paper trading account or simply researching the markets. When it comes to many beginners, they just want a shortcut. And so if the price action looks pretty boring to them, that nothing's really going on, they're not seeing any large bullish candles or large bearish candles, they'll just move on to something else. However, if I play this forward, we can see that this is when this bullish trend started to unleash. So let's imagine that some of them decided to get in. Maybe they had their stop loss set right below this most recent candle's low, and their take profit might have been set somewhere in the middle of where I had my weekly zone. Let's play this forward, and what do you know? The next candle comes in, and this one is even larger and it's stronger compared to the previous candles. And so now these traders that got in earlier, they would have been in profits. So sure, some of them would have made some profit. Others would have continued to hold on because of course the momentum is bullish. Why would you close now when the market is going up? And so that's sort of the mindset that many beginners will have. And when I speak for beginners, I also speak for myself from years ago because this is something that I did myself. And so let's imagine that on top of these beginners that bought over here, let's imagine that now we have even more jumping in right now. And keep in mind, of course, that the traders that are typically getting the best entries are not waiting for these giant moves to play out. They're getting in before these moves become way too obvious. So they would have gotten in way earlier, especially while the price action was consolidating sideways. So to many, when they see these types of formations that the price action is typically moving sideways, it'll look as though the market is pretty boring, and this is when you shouldn't trade it. And although there is some truth to that, especially if you're trying to force trades right in the middle, however, price action typically tends to consolidate for quite some time before you see any significant breakouts in either direction. So keep that in mind, but let's continue this forward, right? So we had some traders that entered over here, some that entered after this candle closed, and of course, at this point, it's very obvious that it's a bullish trend. So when it comes to many traders, they want to wait until something becomes way too obvious on the most recent price action, and that's when they finally look to either buy or sell. Let's see what happens next. We see that we had spiked up. However, keep in mind that before the price action pushed up, if I drop down to a lower time frame, we retraced a little bit. If they entered right away and if they had a tighter stop loss, they might have gotten taken out. But even if they didn't, let's say that they continue to hold on for the sake of this example. So it's just a random example, but I hope that what I'm saying kind of makes a little bit of sense. And now that I play this forward, forward, right, you can see this is where the reversal kicks in. So sure, some traders might have taken their profit had they closed some or most of their trade and they weren't greedy. They would have made some profit. But the second example, where these traders entered right around here at this next candle's open, this is where they're close to encountering a loss. And we also have to keep in mind that when it comes to many traders, they will take advantage of trailing stops, which is basically just an automated way where as the price action moves up or down and you're in a trade, your stop loss will follow through as well. So let's imagine that these traders that entered over here, once the price action was trading up here, so let's imagine that before this drop, the price action was trading at these levels. At that point, their stop loss might have bumped up to these prices down here, because that's typically how a trailing stop might work. And the same could be said for these previous traders over here. So initially their stop loss might have been down here, but with a trailing stop, let's say that it's set somewhere around here at this point. And so now if we play this forward, we can see that these traders, for the most part, would have gotten taken out. And so the beginner crowd, those that were looking to jump in based on the fear of missing out, they're looking to enter somewhere here, or somewhere here. But notice that due to the fact that the markets typically move in waves, they would have gotten taken out, especially if they have a trailing stop that's set. So that's just one downside of having a trailing stop, especially if it's set too tightly. And so like I said, they would have gotten taken out. Let's see what happens after the market corrected to the downside. So let's play this forward. And this is where we can see that this bullish trend continued pushing into the upside. And so basically the whole point of me explaining this is to say that when it comes to trading based on the fear of missing out, a lot of traders, they'll look to jump in without being patient, which typically will lead them into having bad trades, and especially leads into having bad entries, which can develop into a bad habit, right? So if you didn't get in here during this period of consolidation, I'm not saying that you can't trade with the trend, but ideally it's better, right? Especially if you see all of these bullish candles or a ton of bearish candles come in. So let's say you have these large bullish or bearish impulsive moves. A better approach is that anytime you see any significant breakouts, if you want to play it safer and you don't want to risk having a bad entry, then you can wait for a probable pullback that ties into lining up with a level of resistance or a level of support. And so we can see that if I play this forward, this is where the price action dropped down and got pretty close to this 13 EMA. Let's say that, let's call this region a daily resistance zone. Let's connect this to the low over here and to these prices where we've been rejected before as resistance in the past. This is where you could have looked to perhaps enter a trade once the price action tapped into this zone, because at the very least now that the price action has pulled back, you at least are not jumping in due to fear, right? So let the market come to you, don't chase the market. And of course, if you entered over here, this is where the price action would have shot up. And even if you missed your entry, let's say you missed your entry because you had your entry set a bit lower and it didn't come to your entry, which sometimes happens, right? This is a rare example. I'm not going to search the charts to find you guys a perfect example where this doesn't happen, because sometimes this does happen, but at the very least, you're not developing a habit that you get into late, which in the long run, more times than not, is not good to have as a trader, right? So you can get away with it a few times, but long-term wise, this is where you are likely to encounter more drawdowns and more losses. And so this ties into what I mentioned in the beginning of this video, where you need to be patient and you either wait for the market to pull back into a region of support or resistance in a trend, where you then enter your trade, which will also give you a better entry. Or the last thing, and this is important, accept the fact that sometimes you will simply miss out on a trade. Right? So many beginners are jumping into taking as many trades as possible. They're only looking for action. They're not staying patient because they just want to make a quick buck. They want to do it as soon as possible. And so you just need to set your ego aside and accept the fact that sometimes you missed out on a trade setup. So we need to remember that there are always going to be trade setups that will indefinitely exist in the market. So they won't be the same every single day, but there's always going to be a better setup in the future. So sometimes, of course, it depends on your trading plan, but sometimes you just need to accept the fact that you missed a trade and it's better to just move on to the next one and to not chase the market and to get in when it looks like you're about to miss out. Wait for the market to come to you. If it doesn't come to you, if you miss out on a trade setup, that's fine. Accept that as a probable chance and move on to the next one. So if you enjoyed this video, as a reminder, be sure to drop a like. And as a quick reminder, of course, you have the links down in the description to join my free trading community or to become a Patreon supporter to gain access to in-depth live streams, additional guides, additional videos, and much more. Thanks for watching. I'll speak to you next time.